The market is not all about just the rising stock prices. There's a couple different investment strategies, and today we're going to be looking at the top ETFs to be investing in for dividend growth. Now, we know over the last couple years, dividend growth has been exponential. People have been seeking these out, and it has been a way to really supplement a portfolio in an up and a down market. You might not see as much of a downside with these ETFs, or you might not see as much of an upside, but it still does have a pretty good return overall when we break these down. Now, if you follow my channel for a little while, I do not invest in any individual stocks. I do not own any at all, but I actually signed up recently for Robinhood. Don't know what I'm going to be doing over there, but I also do use M1 Finance. But today's video, we're going to be looking at 7 top ETFs for steady dividend and of course, building wealth. Because not only including with the dividend payout that you can get from these companies, there is also a growth factor that comes with it. I currently hold the SCHD, which of course, that has a pretty good growth factor. So what exactly is a dividend stock? So a dividend is a stock or an ETF, a group of stocks that wants to pay money back to the shareholders. It is kind of an incentive, and you have to think of it also from the company's perspective, because the company can either one, give it back to the shareholders in the form of a dividend for holding shares, which makes it a lot more likely for people to actually buy those stocks or those ETFs, or the company can actually take that money and reinvest it into growth and research and development, a bunch of different other ways. So there's kind of 2 different ways to really spin this. If a company is giving an incredible amount of money back to the shareholders, chances are they could fall behind a curve of the research and development side and staying ahead of the competition because they're giving too much back to the investor. But again, some people in some companies do this incredibly well. So why go in and invest for stocks and dividends in general? This is because it is really looking at a lot of high quality companies, looking at the ETFs versus just the individual stock. Now, of course, this is very common when you look at companies like 3M, when you look at Coca-Cola, when you look at some of these that have been giving dividends for 100+ years. It's incredibly crazy. But again, you take these as an ETF, you pull them all together, and they can become incredibly successful and have a very high dividend yield. Now, of course, with the dividend yield, you have to be careful what the cost is as well. When we look at a majority of our Vanguard funds, most of their cost is a 0.04 or 0.03, which is relatively low. Now, I have seen a lot of dividend ETFs that come in much higher, which we're going to be looking at a few just in a moment. So what, of course, is the yield cost? Now, the yield cost, of course, let's say you buy an ETF for $100 and it pays $1 per share annually. This would give it a 1% yield on cost. So knowing exactly what that is as we start breaking these out with our favorite dividend ETFs. Now, what I do is, again, not buying individual stocks, but going in there and doing a lot of research when it comes to the ETFs, because through M1, they do have a lot that they that are available in there. So starting with the first one, which this one's kind of interesting. It is, again, Vanguard Dividend Appreciation ETF, which is the VIG. A lot of people commented in the last Vanguard video we did, why are we not holding this one? And you'll kind of see in comparison, when we keep in mind going through a couple of these high dividend ETFs, exactly the kind of build out. Now, this one is the largest. This is the largest one that we do have when it comes to dividends, the ETF. $74 billion under management, which we know Vanguard is an absolute monster company. Expense ratio on this is a 0.06. Dividend yield is 1.8%. So overall, when I think of dividend, when I think of appreciation, dividend yield of 1.8% for me seems a little bit low when it comes to this Vanguard Appreciation ETF or the VIG. It is one of the cheapest expense ratio wise, but it does not yield a very high dividend. If you're looking to get a much higher dividend, there's a couple on this list that just blow this completely out of the water. But when it comes to stability and when it comes to holding a lot of those really large cap stocks, that is exactly what they do. Holds Microsoft, we hold Apple, United Health, JP Morgan Chase as a mega bank, making sure, again, these are some of the largest companies, which in turn give some back to the shareholders, reinvest all of the other ones back into the company to go ahead and grow. Second one we look at is the Vanguard High Dividend Yield ETF, which of course, this one is the VYM. Another one that a lot of people did bring up when I was talking about Vanguard. Now, if you think about our first one was a 1.6 dividend yield. This one has 51 billion under assets, exact same expense ratio, the 0.06. but this is a dividend yield of 3%. That's right, looking at the other one, a 1.8 of the VIG. This one is a 3% yield on the VYM, which again, this kind of expands it to 460 different stocks. But when you look at some of the top holdings, ExxonMobil, JP Morgan Chase, again, because they are consistently paying dividends, and most of these companies do raise their dividends year over year, which is awesome to see, not only with the appreciation in the growth of the stock, the price of the stocks, and the ETF itself, but also the factor that they're giving you dividends back. The next one we look at is the iShare Core Dividend Growth ETF. Now, this is another one that someone had brought up to me. Really looking at it, 26 billion under management, a little bit higher of an expense ratio of 0.08, which is still super low when it comes to ETFs. Dividend yield on this one is at 2.4%, and very similar to a lot of other companies, they are holding a lot of the very similar holdings that we see with the JP Morgan Chase, the Microsoft, on the Apple. A couple of those are kind of run the same. Now, the ticker symbol of the iShare Core Dividend Growth is DGRO. This one, again, is very well established like the VIG, committed to growth rather than the dividend yield. That's why it is a little bit higher. So you're going to get kind of the best of both worlds with this. It's going to be a little bit focused on more of the dividend growth rather than the dividend yield. So again, long-term, if you're holding this, could make a big difference on how much this is actually growing. Then we start getting into the pro shares, the S&P 500 Aristocrats. If you've been familiar with the Aristocrats, it's actually really, really cool. So this is the idea of taking companies that have a crazy long time with a growth track record as far as giving back dividends. To fall into this elite group, they have to have increased their dividend payout for 25 consecutive years. Even though there are companies that have done this for an incredible amount of time, that is much longer. 25 years is the minimum for the Aristocrats. Now, this contains 11.6 billion. Expense ratio goes to 0.35. Now, again, when you kind of think of that in the terms of what we're paying for Vanguard at a 0.06, or a 0.08, even with the iShare, 0.35 gets a little bit more. That's about $35 for every $10,000 that you have invested. But the dividend yield on this one is 2.5%. So again, dividend yield pretty good, but it's really just focusing on those companies that have increased the dividend yield, which means as a baseline, if you purchase this one today, the dividend yield is going to go up because all of the companies that they are holding do have that history of going up and increasing dividends year over year over year, which is awesome. Now, this only includes 70 stocks, which makes this up, but they also have, it shows other ETFs that focus kind of on the payout. It doesn't look and doesn't offer the highest payday, but stability and consistency on the dividend payouts is what you're looking for on this ProShare S&P 500 Aristocrats. Then we get into the crazy. When you look at the Global X Super Dividend, that's right, they even added the name in there. It is the Super Dividend ETF, which is the SDIV. This is focused on dividends, 742 million. So we're not even broken into that billion yet. The expense ratio of this goes to a 0.58. Dividend yield is 10.4%. That's right, guys. Let me say it again. The dividend yield on this is 10.4%. So if you're putting money into this, it is yielding over a 10% yield, which is kind of crazy when you think of why it is so high. Now, the big thing with this, it prioritizes yield above everything else. So you have to take that with caution, generating a current payout of more than 10%, which is nearly 7 times that of the S&P 500 and 3 times what 10-year treasury bonds will do. But again, it prioritizes yield above everything else. Now, this doesn't only look at dividend ETFs. Third of the assets are actually held in real estate, energy, materials, and a couple other things, again, that can be very sensitive to interest rates and also the housing market, because there is a big chunk where they are drawing these dividends from to get that 10%. Also noteworthy, only 1/3 of the holdings are US companies. So again, when it comes to stability, when it comes to risk, when it comes to reward, this might be something that you want to have a percentage of the portfolio in, but not your entire portfolio to get that 10% yield, because with a higher yield does come a considerable amount of risk. Now, outside of those dividend, I mean, just really getting into buying stocks, there are a lot of ETFs that actually give a really solid dividend that are based outside of the stock market. The first one we look at is the Vanguard Real Estate ETF. That is right. We are investing in real estate, holds $32 billion, expense ratio of a 0.12. And you can see why I buy the Vanguard funds, because they are incredibly cheap when it comes to that expense ratio. Dividend yield on this one is 3.8%, but as it reads, it is real estate. They are holding REITs, they are holding buildings, they are holding apartment buildings. They're also invested in a lot of commercial and a lot of warehouses, infrastructure, a lot of things within the United States. And they give the dividend back to the shareholders in the form of, again, this is real estate instead of it being in the market, which again can fluctuate. We know there's going to be and has been a pretty bleak outlook when it comes to commercial real estate, just from the fact that so many people are working remotely and from home, that we're not seeing a ton of people actually going into the office. And the last one we're looking at this list is the iShares International Select Dividend ETF. This is the IDV. This one, $4 billion in assets, 0.51 when it comes to that expense ratio, but paying a 5.9% dividend yield. And of course, this is the only one that a majority of everything is outside of the United States. It is international. They pay less frequently than US stocks. Some of them might pay once a year instead of once a quarter or once a month. Some of them do pay twice a year, but again, it really fluctuates on seasonality of companies. Now, of course, when you look at this, it says it holds roughly 100 stocks. Dividend in the ETF portfolio are some of the world's largest and most established firms worldwide. This is global. It shows even, Rio Tinto Group in here, British American Tobacco, UK components, Australia, Canada, South Korea, Japan, several other countries that have a very predominant position in this ETF. So when it comes to this one as well, guys, make sure that you do your research with these ETFs. But overall, when you look kind of again at that risk reward, if you're getting a 3 to 5%, because remember, that is going to be that dividend yield that we're seeing there. 3 to 5% is pretty good. I know there's a couple that pay higher. When you look at Verizon, when you look at AT&T, there's a couple providers that give a pretty solid dividend for the company that it is. But overall, ETFs is where I'm sticking, and ETFs is what I do invest in. All right, guys, so that is going to do it for today's video. Let me know in the comments what you guys think. And as always, thank you guys for watching.